Hey, greetings, fellow traders. It is Wednesday after the close. We're waiting for Facebook to announce earnings and, of course, Apple tomorrow night. I'm Samantha LaDuc, founder of LaDucTrading.com and CIO of LaDuc Capital LLC. I'm joined by Craig Shapiro, who is a hedge fund manager, former client turned macro advisor exclusively for LaDuc Trading clients. He also runs our institutional edge product, so able to provide that concierge outsourcing macro advisor hat and support real-time trade management engagement with clients, mostly macro and fixed income and equity traders of who are managing money. So this is really very helpful since we're in a macro to micro environment where macro still is major risk. Micro has all these twists and turns. That's what I try in time and give reasons for and levels for in my live trading room. So he's the macro, I'm the macro tourist, and I use that macro to micro to better time inflection points. And we're going to talk about that. So we had a big theme going into the past few months, obviously, that the market has topped and we're going to have to endure these bear market rallies. But at the same time, our theme has not changed, that NASDAQ underperformance as a result of this, Fed hiking regime, which is not going away. So we've definitely talked about this, on Twitter and, with each other, but we decided to do this webinar 2 weeks ago, Know What You Own, because we were sitting on some really serious levels of support that could be crashed through as it related to bonds and stocks. So we were both max bearish, and we did this webinar, and then basically know what you own, because the risks are increasing, not decreasing, in both macro and micro, meaning this market structure that we have is getting more fragile. And then right before last week, when we had announced that we were going to do it again, this particular episode, if you will, of Macro to Micro Power Hour, the focus was going to be on this brace for impact, because I had put out a warning quite audibly, both for clients and as well on Twitter, which was brace for impact if bulls don't defend here. And that was very specific on Thursday, the day before the Friday Bank of Japan intervention. So for those who may not know, we had a massive Bank of Japan intervention where they bought yen to keep the USD JPY from further becoming unpegged and untethered. So they basically saved their bond market. And this was very important because it helped pull down our dollar and our yields, US dollar and yields, to create this risk on movement. We also had Yellen coming out, talking about Treasury buybacks. And we also had the Wall Street Journal Fed Whisperer come out with an article exactly at 9 a.m., right, 30 minutes before the yen intervention, where there was concern by Fed heads wanting to slow down the rate hike intensity and path, so intonating a pause. So that was basically the three legs of a table that allowed bonds to stop falling, and they were absolutely ready to cascade lower. It also helped the dollar pull back, and that gave equities all kinds of confidence to short, monetize the puts that they had been holding, and then chase calls at elevated speed. So both Craig and I are like, they're really going to do it. Like, we're saying careful out there, know what you own, brace for impact, and then boom, that happened. We had intervention, and not a little bit, a lot. So that intervention is basically the event that has triggered this most recent rally of Friday, Monday, Tuesday, and Wednesday, despite the missed earnings by Google and Microsoft, which have been very strong trend reversal candidates that I've recommended to clients this whole year. So now we're awaiting Apple tomorrow night, Bank of Apple, and that will impact sentiment, no question, as well as price. But the way that the market is behaving, it just seems very, very bold up into FOMC on February 2nd and midterm elections on did I say February? November 2nd, and FOM midterm elections on November 8th. So that's my thesis of how we got here and why we're, getting together today. I also wanted to just ask you to stay tuned to the end of this webinar. There will be a promotional that James, our lovely director of marketing, has put together for those who would like to join my service, which is the Fishing Club service. And then we have basically an upgrade to a MacroADVISOR service that Craig posts in. It's not the Edge product. The Edge product is very much concierge, customized presence for those who really want a macro advisor on their team. And that's the role that Craig serves. But it is absolutely beneficial to understand what's happening in the macro backdrop with economics and yield curve and central bank decisions across fixed income, currencies, and equities. So I invite you to stay tuned to the end of this webinar, so we will promote and publish that particular offer. And now to Craig. Craig, hey, happy Wednesday.
Good afternoon. Thanks for having me again. Another wild day, another wild week. It's it's really feels like it never stops. Yeah, look, I think what we spoke about a couple of weeks ago about my framework and what I was anticipating regarding the need for the Fed to provide incremental liquidity in order to allow risk asset markets to work. That hasn't changed. I don't really anticipate the Fed doing anything different from what they've been saying they're going to do. But what we find continuously is when we get to what seemingly key technical levels or key levels on your volume charts, which we talk about all the time, or key levels in various FX crosses or the bond market where rates are, we almost inevitably get an invisible hand type reaction. And I think just has a lot to do with positioning and maybe some uniformity in a trend view that many investors across a variety of asset classes have about how to play this. And so when things get extended in one direction, they get extended across many asset classes. The dollar rallies, bonds are weak, credit is wide, stocks are down, and everyone's leaning in that direction, kind of anticipating a hot CPI print or a hot labor print or a Fed speaker that's going to come out and say the terminal rate should be going higher and higher and higher. And then all of a sudden, we start to worry about the system and fragility and financial stability. And then boom, something happens and we go, a comment is made that sounds like it's important and it's really probably not, but because the way everyone is set up, it becomes important. And it creates a counter trend narrative that forces FOMO in a lot of ways, and position closing down, risk reduction, and it gives the appearance that something has materially changed. So I think what we had kind of last Friday was this kind of combination of, dollar yen moving kind of through 150. And the market was testing to figure out where the BOJ was going to intervene in a large way. And at the point in time on a Friday morning, Nick Timiraos, the Fed whisperer for I don't know if he's self-anointed or if that, I know he did a nice puff piece in New York Magazine a couple weeks ago. So he's pretty, high on himself and on his calls, but, kind of put out a piece that sounded like the Fed was really actively discussing a step down in rate hikes, not for this meeting, but for December, and it will be discussed in this meeting. And, look, I think if you kind of read, and I go through all the speeches, I listened to most of them, the things that he was pointing out were things that were known as far as what Daly had been saying, what Evans had been saying, and Bullitt. These guys speak all the time. So it shouldn't have really been a surprise that there are some dovish members of the Fed, led by Brainerd, who would like to see a step down in rate hikes. So shouldn't have been a surprise. But when he puts it out, on Friday before the blackout period, and the terminal rate, had been above 5%, which is well above where the dot plot was suggesting, you kind of kicked off this reaction function. So you have this idea that Powell, Nick speaks for Powell, the Fed is moving, then the BOJ comes in, sells dollars, and kind of creates this spiral effect where people were short need to cover. There's expiry, a lot of volume on the tape. Bonds that got extended. So, 1 + 1 + 1 = 10. And it looks today, or it looks, let's say, before today, like all systems go. The Fed is going to pivot. They're going to pause. It's kind of confirmed by, Canada this morning. They're slowing their rate hikes down. Australia has already done that. Mexico is considering doing that. So it sounds, then the PBOC comes in and intervenes, and it feels like, there is this kind of globally coordinated effort to slow down the pace of rate hikes, even though inflation has not been solved. So, where does that leave us? I mean, as far as equities are concerned, equities still have to deliver on earnings in order for this to work. It may be the case that a terminal rate above 5% at this point in the cycle is too high, and so we really need to be in the kind of 4.8 to 5 range, which is where the dot plot is, really for 2023. And so if the terminal rate can't move higher, then maybe multiples on stocks won't go lower right now. But the other side of this is earnings. And while there have been, several good reports off of low bar, to start this earnings season.
Off a low bar. That's
a low bar.
Phrase.
We're now into the big guys reporting, and yesterday really for me, I think should kick off a downward revision cycle for earnings that will not be equity friendly. And it's something we've been talking about for months, and the street's been very sticky, not to move 2023 numbers down. But after Google and Microsoft, kind of two bellwether behemoths, report tepid outlooks, taking down numbers for next quarter and for next year. And now Facebook or Meta, whatever it is, just reported stocks down 7%. I haven't seen what's going on there, but clearly stocks at the lows and then, making another move down. I mean, I think we're going to be into this negative earnings revision cycle right now. And I know that in a high inflation environment, nominal earnings and nominal sales can be high, but we earnings need to come through. And if these earnings prints don't come through, then while we don't have continued multiple degradation as a potentially, not a negative factor anymore, if the E's coming down, stocks aren't going to work. So, we have Apple and Amazon tomorrow after the close, but my sense is, the positive earnings that we're seeing in names like Exxon and upstream energy are not really enough to drive the entirety of the tape higher. So, leave it. I'll stop there, but that's kind of my, kind of thought about how we got to where we are right now. But, still holding out on a view that I don't think the Fed is really in any position to change course. And I don't suspect that there was this globally coordinated effort to really loosen financial conditions with inflation still as robust as it is.
So do you think it's political?
I'm not sure, really. I mean, I understand this idea that, the administration wouldn't want to see a further market correction 2 to 3 weeks before the election and would get blamed for that. But I'm not really sure that's something that the Fed, necessarily, cares about and wants to go out of its way to avoid. But again, just given where positioning was, it just, it allowed us to alleviate that oversold. And now, where are we now? We're in a position now where the markets have rallied now aggressively off the lows. Inflation expectations are moving higher again. Break-even yields are moving back to the high end of the range that we've seen over the course of the last 3 months.
Your break-even, yep.
So, for me, I look at the Fed has, I guess, 5 different things it could look at in order to kind of, choose to reverse course or pause this course. And let's take these kind of in reverse order. The labor market would be the first thing, or maybe the most important thing. If the labor market were to deteriorate, that would give them, something, I guess, to pause on. Frankly, the labor market is as hot as really we've seen in quite some time. We have a wage number that comes this Friday, which will be very important. It's the third quarter employment cost index. Powell has said specifically this is something that they really look at. Street is looking for a sequential tick down in the growth rate for the third quarter versus the second quarter versus the first quarter. So I suspect this is going to, if this moves higher instead, then the labor market is not going to be a reason that the Fed could pause. That to me, that's the furthest away from pausing. Number two would be actual inflation falling. We've seen kind of headline CPI is a little bit off the highs because oil has come down, but core CPI and core PCE, Dallas trim mean, Atlanta sticky Fed inflation, Cleveland Fed. I mean, these readings are all broad based and basically at the high. So there's really been no sign yet that inflation is falling. It's anticipated to, but it hasn't. So that's not happening. The third thing would be inflation expectations. So if that were to move lower and become de-anchored from the low side, then maybe the Fed could say, look, our tightening has done enough. We've been restricted enough, and we will be able to pause our tightening agenda. Well, like I mentioned before, and you're showing here, since the beginning of the month, these yields have moved kind of 30 plus basis points. They're above where they were when Powell spoke in September. So they're back there. They're moving higher again, not lower. So again, the bar for them to use this as an excuse to pause their policy path, that doesn't seem there to me. And then the fourth thing I would say is, well, the growth data is deteriorating, and they can really start pointing to, the slowdown in the economy. Look, the Atlanta Fed GDP estimate for the third quarter is ticking a new high for the year. So, there was talk early in the year about a recession, which the Fed said didn't happen. You can't have a full employment recession. And now, look, we're seeing GDP above 3% expected for the third quarter. We're not in recession. The City Surprise Index, which I also flagged, is another kind of forward indicator about how data stacks up versus where expectations are. Earlier this year in June and July, there was a rapid deterioration in the data and the expectations of data. Data was missing continuously, which I think led to this concern at the July meeting for the Fed, which kind of kicked off a pause trade, which ultimately that needed to backtrack on.
Yep, petered out. So if I look at the City Surprise expectations now, they're hovering around zero, and they've been trending up for the last several months. So I think we need to see a rapid fall there as well in order to get the Fed to pause, which kind of brings me then to the fifth point, which is this financial stability idea. And really, it's an international financial stability idea. Like, is there pain or strain in global markets that will feed back into the U.S. economy or U.S. financial markets that would lead the Fed to do something? And look, I mean, we are seeing strain in a variety of FX crosses. Clearly, China this week and last week, we can talk about that in a little bit, but there's some issues there, dollar yen. So clearly there is global strain, but after a 10-day move since our CPI print, the dollar is off the highs, bond yields are off the highs. We've had some, the UK situation has been fixed for now. So a lot of this heat on the or boiling of heat from international financial stability risk, I think that ultimately will be the place that'll cause the Fed to pivot and pause and pivot, but I don't really see it yet. And Bullard and Waller have both referenced this St. Louis Fed financial stress indicator as a financial stability indicator. It's at the lows. I mean, it's in negative territory there. It's showing no system stress for the U.S. and U.S. economy. So, which one is that again?
It's called St. Louis Fed.
Okay.
Financial Stability Index.
Yeah, no, you sent me two, but I don't see
that.
that.
Oh yeah. My apologies. But so look, I think that evidence to me all suggests that the Fed is not moving, is not changing, is not doing anything different from what they said they were going to do, which I think then really sets up a potential situation this Friday. We have the PCE print and this ECI print. You know, I think if those are both firm as expected, you know, I think the messaging from the November meeting next Wednesday may push against what Timorous was kind of suggesting, because the hawks, who are Powell and most of the governors and most of the board, still are not in the Brainerd camp, and there will be no real data to suggest that it's time to move. So that could set up, you know, that could set us back up for you know, another replay of the down trade, and you know, we're you know, go back to the low end of the range again into the election. So yeah, that's what I think is going to happen. But clearly, you know, when we've moved, you know, 300 plus handles the other way, you have to kind of, you know, assess and think about, you know, what you got wrong and what you missed. And I think we're doing that now. And you know, but I don't really think the trend has changed.
So Hartnett was out, Bank of America, Hartnett said quantitative tightening is slowly morphing into quantitative tinkering. So to imply that, you know, Powell might do a little dance around Operation Twist, even in sentiment that would be very market bullish. What do you think the chances are for that, given all the backdrop of reasons for Fed to continue not only sounding hawkish, but following through with hawkish hikes?
I mean, I would be very surprised by that. I don't think that's on the agenda, certainly not for this meeting, really even not for next meeting. I mean, you know, they're just really getting going on the step up in QT. They're not hitting their targets on the MBS already. So because high interest rates has led to lower prepayments, and so there's less money that's been coming back to the Fed from there. So I don't suspect I think eventually they will slow down the pace of QT. But again, it kind of gets back to this framework of, well, what's the reason? Why are they going to do it? I think the more, you know, people are more focused now on this idea that the Treasury is going to start doing something.
Yes.
Yellen has been out, you know, several days over the course of the last 2 weeks since the IMF meetings.
Every day.
About Treasury liquidity and whether or not it's good or bad, and how could it be better, and what could we do about it. And even though we're in, you know, supposed to be at full employment and a robust economy, there's some issue in the Treasury market. So she's mindful of it. I think a Treasury buyback, I mean, it's not really an expert, you know, in this field, but ultimately what they're going to wind up doing is issuing more short-term bills to buy less liquid kind of, you know, bonds that sit either on bank balance sheets or on, you know, private investor balance sheets, because, you know, these bonds are less liquid, they're off the run securities, and there is a need for a kind of a marginally higher capital charge for banks, and so banks don't really want to hold them. And so that's the liquidity issue that they're referring to, and there's some idea that potentially, you know, doing a buyback and issuing more bills provides more collateral, which would take more money out of the reverse repo facility into bills. I don't know. It's a lot. I know, you know, Joseph Wang, the Fed guy, has talked a lot about it. Seems like, you know, there is momentum on there. The TBAC, which is the Treasury, you know, basically the Treasury committee that talks about debt. They spoke about it at their last meeting. They put a feeler out to the street a few weeks ago. They meet on Monday, and there'll be some news out on Wednesday about whether or not so that's the same day as the Fed. So, you know, but ultimately I don't really think this is a story for 2022. Most of the street guys who I've been reading say maybe if this happens, it's, you know, more of a 1Q23 or 2Q23 event. And, you know, but in my mind, like, they're issuing, you know, higher yielding bills to buy back lower yielding bonds. I'm not exactly sure how that's a great idea from a taxpayer, you know, cost of funding perspective for the government. So I don't really know if that's going to be kind of some panacea that everyone expects it to be. I was chatting earlier today with Luke Roman. He mentioned something incredible to me, which I did not know, which is that I didn't realize that Treasury has to roll $6 trillion of debt in 2023. It's just a staggering number. It's an enormous number. You think about where bill yield, and obviously a lot of that is short-term paper. You think about where bill yields are today versus where they were a year ago. I mean, we're up several 100%. So cost of borrowing is becoming a larger issue for the U.S. government. I suspect that's also why Yellen is, starting to push back a little bit. She knows, a much higher interest rate for the U.S. government is going to be a problem for how we pay our bills, and interest expense going up is, kind of a growth headwind. So, there's a lot going on there too. But I don't think that's your original question. I don't really see QT changes imminent, unless we start to see these inflation expectations falling and more strain in global risk.
Well, I'm just highlighting as you're talking, bringing up some relevant charts to kind of that I've, retweeted or presented in Slack for our client workspace. Fed's losing billions, wiping out profits that funded spending. So all of this recycling plan that Yellen talks about, I'm sure needs to address some of this. But again, that's the plumbing that I don't follow closely enough, but I can definitely smell the desperation and definitely needing to do something. I'm very much, transfixed with my intermarket analysis, and that has gotten me into this whole, rates higher theme, lower bond theme, and then its impending impact on the market. Today, Bank of Canada underwhelmed with a 50 basis point hike instead of 75, and also said that they're going to end QT. It helped with this kind of Fed pause sentiment for higher. What's your feel for any of what the rest of the world does as an influence to Fed moves?
Yeah, look, part of me thinks that these foreign central banks that are, Australia has already slowed down its rate hike pace. And what we saw last night was a re-acceleration of the CPI. Canada is doing a similar thing, kind of read through their transcript. There's basically no reason for them. They basically, everything that they said, suggested they're more concerned about inflation than not, but they just slow the pace down because they wanted to. Mexico also has talked about, kind of a similar thing. So look, I think part of me thinks that they're all making an incredibly big mistake, and that they are not going to be successful in solving this inflation riddle and bringing inflation down. And I think collectively what they're all doing, knowingly or unknowingly, is making a very large bet on oil.
It's going to get easier, because I am seeing every time that yields pull back, oil pops up like a daisy.
And I think that makes total sense. So if you're a central bank that is concerned about inflation, but you're going to lower rates, you have some expectation that inflation is going to fall. Now, those expectations that inflation is going to fall have been wrong for months, quarters.
Yes. I showed that chart as well. Inflation consensus, wrong for 40 years. So bias.
So my view is they must be making some sort of bet that Saudi and Russia, who right now that the West has strained relations with both, that somehow they're going to allow the oil price to fall a lot here to make it the case that inflation is going to fall. It seems like a very misplaced bet.
Yeah, I'm with you on that.
But it's happening.
But before we get into the oil market, because I have strong opinions on that as it relates to this inverse relationship with the yield. It's a yield play, like very much so, with the dollar yen. Just kind of highlighting something you were talking about, rolling these the debts. First and foremost, going back to the big picture, unless interest rates do start to fall, right, sharply, which we do not, you and I both don't expect, but I think they really do for next year. I think 97% of surveyed asset managers said they expect rates to fall next year. In any case, the interest expense on public debt is going to surpass 1 trillion on an annual basis and become the largest line item in the budget. And I mentioned that because it is shockingly worst nightmare. So many people have been waiting, anticipating for this higher rate regime to actually wreck our global debt dependent economy. And then you were talking with Luke Groman. I came across this cross-border cap estimate that global debt at 350 trillion with an average maturity of 5 years. That's basically 70 trillion every year needs to be rolled. And that's $8 of refinancing for every $1 of new financing. So assuming that that's, even in the ballpark, that's just scary.
Yeah.
So in regards to this Fed pause, theme that is helping the markets basically get going for a bear market rally, what are you looking for triggers to basically short the rip?
So I think if the I'm gonna try to send you this chart here, but
and I meant to ask you about the 3-month yield.
Well, I was just gonna send you something on 3-month 10-year.
Yes.
I mean, you have that chart or no? And it's 3-month. I think if
you put it in Slack?
What's that?
You put it in Slack?
No, I'm about to just put it right now. 1 second.
Okay.
I think if there was a real story going on that I'm just trying to snip and talk at the same time. But I think if there was a real story going on here about a pause, pivot, and that the Fed was not going to be successful in achieving inflation, its inflation target, we would start to see a steepening of the curve. Because there would be a credibility issue that the Fed's not going to be successful. I think the long end of the bond market would be selling off. So we would bear steepen on that. We could even bull steepen if there was a view that short-term rates actually were going to come down. So we're not seeing that. We're not seeing the long end sell off here. Now you may say, well, it's because it's quite extended and but over the last few days, the entirety of the bond market has rallied. So I just shot you a chart of 3-month 10-year, 3-month in flat. Yeah. I mean, 3-month 10-year is the Fed's kind of preferred measure of the curve, and we're at the lows, and we're inverted now. And so look, that is something that they have said is the most important yield curve indicator that they look at. And now that we're inverted, clearly from all their models, they would have to believe that the odds of an over tightening or the odds of a recession are higher than they've been. I mean, they've tried to say that the curve inverting is different this time because of their view that the market believes they will be successful in fighting inflation, and that's why the long end has been more depressed, which has created the flattening. I'm not sure I believe it, but that's Bullard has said that, and others have said that's why they don't really look at the curve flattening as some risk. But now that their preferred metric is showing inversion, I suspect that they will, they'll be asked about it. Powell may be asked about it at the meeting, and he'll have to kind of address, whether or not they're doing too much. But, as far as
this is a 30-year, I'm just bringing up a chart of 30 and 3-month because it is, pretty telling that it needs to get inverted and stay inverted for a solid tell on a recession of size, right?
Yeah.
So now everything moves at warp speed. It's much, much more reactive. So, market moves are moving because optionality is intensely bid up in options, not the underlying. So we have a lot faster inflections for sure, plus all the quants chasing, math levels specifically. But this is at this inversion only by a hair just recently this week.
Yeah.
What are your thoughts? Will it bounce here? Will it break below as it relates to the longest 30-year against the shortest 3-month?
Yeah, look, I guess I'm not surprised that we are kind of right here at this level of, basically flat, maybe into, the Fed meeting next week. I think if the Fed is, hawkish or, in my view, consistent messaging with what they've been saying, that they really are serious about stopping inflation, that Powell really is going to be Volcker and he's not going to be Arthur Burns. What'll happen is that this curve will further invert. And we will, probably have a significant, risk off event in that setting as the market comes to grips with the reality that the Fed is not providing liquidity. They continue to contract liquidity. They are really serious about fighting inflation. And, this most recent bout of, this most recent counter trend move on a pause is really a fleeting concept. On the flip side, if he somehow confirms that, despite all the stuff I went through earlier, there really is calls for a step down and a quick step down and making sure that the terminal rate doesn't move higher. What I suspect would happen in that environment is market would start to question whether or not the Fed has the resolve. Powell really is going to be Arthur Burns. And in that setting, I think what would happen is the dollar would weaken, but bonds would sell off. The curve would steepen. Gold would rally, Bitcoin would rally, and oil would rally as inflation assets start to become, back really in vogue again on an idea that, the Fed tried to get it down, but because of concerns about the growth outlook globally and maybe into, the US, maybe some political nonsense as several Democratic senators now are pushing back against the Fed for over tightening, for the risk of over tightening. I feel like they don't know what they're talking about, but, Powell then becomes Arthur Burns, the bond market sells off. We get a kind of risk rally on that dollar weakness, but I don't really know if the bond market does sell off materially. I'm not really sure how far equities are going to bounce, but I suspect they would bounce probably up, through 4,000 into maybe up into the, whatever the 200-day or up at higher levels here before they, sold off again. But so I guess it's not surprising that we are here at these levels kind of into this meeting. And I think it is an important, another important meeting to determine whether or not Powell is going to be Burns or going to be Volcker.
Yeah. So that's a good summation of bond land. I just have one chart that I have been really, really fascinated by for a year now because it has just fallen out of that channel beautifully. Now that's just the 30-year. We're talking about, this bear steepener, where the 30-year would basically outperform the 3-month, and the 3-month is already exceedingly bid. All of these yield indices that I have been, showcasing have this rate of change, which is massively still bullish. It's a momentum impulse, a multi-year momentum impulse, and none of them have really based safely, stabilized, if you will, and turned higher. So we're kind of like catching a falling knife. What is this to me though is extremely dangerous. I still don't see anything other than a potential short, bounce in this structure. Otherwise, I still see a lot of risk to the downside in bonds and stocks after we get through the next little, charade of FOMC where they just say, yeah, we're going to keep doing what we said we were going to do.
Yeah.
The other is this is what I mean by the rate of change, by the way. All of this has this rate of change indicator that is just hot fire flames and has stayed bid up since summer of 2020. So we're now not only at 2011 highs, we're percolating higher up to, 5.5%, 6%. And that's still very, very hard, I think, for folks to get their head around. I mean, without just saying, oh, I see it higher. I mean, strategically, this has been extremely tactical as it relates to moving higher with momentum. We did talk about that. You're right. The dollar pullback, this and a little, this is golden verse, but the point is it's come back down to a daily channel support around this 109, 110. That doesn't mean it's busted. Obviously, if it keeps going out of this channel, I'll have a very different view, but I'm going to give it a little bit more time into next week post FOMC to see this get back inside. But we get back inside, this dollar rally to me is going to pick up speed to the upside. So for right now, we're just coming down inside this channel and poking below, just like we did back in August when we had that big July to August, mid-July to mid-August short covering rally. But big picture, it's still definitely not out of trend. And then the yen, with this dollar yen that came back with Bank of Japan intervention, it has definitely, just for a great quick trade, been a fabulous vehicle. This is FXY, but the same idea. And I wouldn't be surprised if this gets into the 64, 65 area, but then breaking above it is a whole nother matter. I still think the trend is lower. Mm-hmm. So you were talking about the dollar, and you've talked a lot about the dollar from a macro standpoint. What's your feeling of where we're at right now relative to emerging market risk? And we've talked about the dollar swaps and the intervention, but as it relates to bullish or bearish, big picture, not this short-term pullback into support because of an intervention leading up into FOMC and midterms. What's your sense on the dollar?
Yeah, I think the trend for dollar remains up, remains bullish. I think what we've seen, last 10 days or so is this counter trend move kind of back into support. I'm looking at dollar CNH, right? Made a high yesterday and has had an aggressive move, back lower over the course of the last 36 hours, back to the 20-day. I mean, but ultimately my view remains the Fed is still the most aggressive central bank, and the US economy is still the most robust economy. So from a growth and interest rate differentials perspective, it's favorable for dollar. And so what I think is continuing to happen is, as we spoke about last time, many of our allies in the UK, in Europe, in Japan, who are energy importers, continue to have to raise dollars by selling their treasuries or their reserves in order to pay up for the import of energy and food. That trend hasn't really changed at all. And as far as emerging markets, I mean, there's an election in Brazil this weekend, so who really knows? I was pretty weak today. I mean, Mexico, some talk about them slowing down the rate hike plan. I think that would be negative for Mexican peso. As far as Asia is concerned, Korea is intervening. Taiwan has its issues. I mean, there's just not a lot of great cases to be made for emerging market FX currently. So, for me, I think this is kind of the pause that refreshes, and we'll have one more kind of move here in dollar higher. That maybe is what ultimately causes this Fed pause reaction function when something really does break, and maybe there'll be some evidence of negative divergences at the highs, right? If that's something that we notice, if dollar yen makes a new high or dollar CNH makes a new high with divergences, maybe that'll be a signal that the dollar has topped out. But right now, fundamentally, I don't really see it.
I have a chart that I like, which is big picture, obviously, but SPX divided by the dollar. And you can kind of see this ratio over time. And then, of course, the COVID low and the breakout, quite large, obviously, from March 2020 into today. And this is still rolling over, which is just basically saying that the dollar was moving higher, SPX lower, and it's still a broken pattern. So we could rally, relatively speaking, meaning with indices and the dollar weakness, right back into the underside of this trend line and continue lower. But it's still a broken structure. So for me, it's there's lots of charts that are intonating risk, even, the dollar Swiss franc, which nobody would expect it to go anywhere, but it is intonating a breakout on the monthly. It hasn't triggered yet. There are just so many charts like that, that I think, for me, it's really interesting to see how far, here's an example as well, we can get with, hold on, even the dollar. Speaking of the dollar, this is the Dow Jones divided by the dollar. Why? Because it has this great pattern that can show kind of when we have the strength in the indices, weakness in the dollar, like we have had the past few days, but we're right up into resistance again. So we're coming into a place where the dollar very well could get supported. I think that's my baseline bet. We're gonna have to wait, but here's the same thing, right? SPY and dollar, it's just having a nice oversold bounce, but the pattern is broken. We still have lower levels we can move, which to me says dollar much higher, and SPY and especially NASDAQ is also at risk of the same thing, right? So this is part of that kind of intermarket where NASDAQ relative to the dollar has been weakening with dollar strength. We're having a little kind of stay of execution here, but we definitely have lower levels. And then we've got some big risk off. If the Fed is really going to get through to the message to the market that they have no interest in pausing, then I think that will start to get reflected as well. Probably the strongest is is this, speaking of, we're all rates traders now, this is SPX divided by the 10-year, right? This is a massive, right, 40 plus year channel. Then we had this breakout and we've since rolled over, but we've broken. So this is basically just saying that yields are much stronger and bringing the market down, I mean, in a nutshell. And so we can have some stabilization and some mini bounces, but it's still a bear market rally. And right now we are underneath just a lot of resistance. So the past few weeks, this happens to be on a weekly, that has to be on a monthly. But the point is, the past few weeks, we have just been in this aggressive consolidation pattern where obviously yields and dollar have softened thanks to the Yellen daily piece of threats of treasury buybacks and the Bank of Japan intervention and the Fed pause sentiment, but it's just sentiment. So I still think that this is broken, that the market as it relates to yields have not at all given an indication that they are done going up, and dollar is done going up, and bonds are done going down.
Yeah.
So where do we go from here? How do you feel that this is going to be playing out for the rest of the year? I know that's kind of a big jump, but we do have lots of media economic data, including non-farm payrolls. We've got the Fed meeting, and we've got Santa Claus rally and the rest. So there's no lack of market moving news. Yep. And there's also no lack of this intensity of market structure where the options market right now is beyond, and I do mean beyond silly, with chasing the right tails, the crash up. I had posted, and I thought this was just kind of interesting to make note of as well, to show the intensity of this option market driving a lot of this call buying, which is driving a lot of the rally. Basically, McElligott kind of came out and said, we've got these right tails crash up, hedges from underexposed buy side, right? So lots of people, why hedge? They've already sold, or why hedge, which are selling, but now we've come down into a place where they're afraid of missing, terrified of missing the pivot rally. So this is the upside move, and it's so strong that October, this is the first October, the best October, excuse me, since 1896.
Wow.
So it's an intense, short-term rally, but the problem is the ricochet effect. So I also kind of put that in another stat, which is right here. literally, we already know that 40% of options traded are weekly options. So this fanatic FOMO move, both by institutions and retail, has become a thing, right? But then we also have, you can kind of see, massive, a trillion notional dollars in notional trades now on a given day. On those zero, destination till empty. So
Right.
they expire worthless on that day. So get in there real quick, fight theta decay, and just drive this single stock gamma option flow crazy. The problem is it really can work on the downside as well. So we saw, you and I, this kind of max bearish thing going into last Friday's Bank of Japan intervention. Now that is done, and it actually stuck. The last time they did this, it reversed the next day. So it was really a one-day wonder. This actually has lasted for, a good, so far, 4 trading days. So given that they have this kind of concerted effort to support the market right at a pivotal area before it fell over, and I got lots of intermarket that showed we were really at crash risk.
Yep.
So close. It was so close, and boom, they came right in and defended. Where to from here for the rest of the month and year?
Yeah. So I'm looking at this in, let's say, like 3 time frames. So the first time frame is very short term. What we have over the next, through next Friday, even through the election in there, so through the following Tuesday, we have the ECB meeting tomorrow. We have the Bank of Japan meeting on Friday. We have Apple tomorrow night. And we have the Fed, we have the PCE and the ECI on Friday. We have we have ISM on Tuesday. We have the Fed on Wednesday. We have payrolls on Friday, and then we have the election. That's your very short-term window. What I think happens is I think we are going to retrade a risk-off flavor now into these events. I think this move that we've had has come too far too fast on a belief that the Fed is going to pause, pivot in the leg. I think they're going to come out, after strong data on macro data on Friday. I think next week that at their meeting will resume a kind of hawkish intent that will take us back down again. And we will probably start to think about, are they going to break the lows and what's going to happen, and is there going to be some sort of kick save in the middle of November or into the December Fed meeting? Maybe we'll be having this conversation at the lows and everything will look like crap again, and we'll say, it's time to get bullish again. Maybe it'll break that time. I don't exactly know. But so the short term time frame is I think we're going to have a bout of risk off here. And I think from that, you mentioned just kind of the gamma perspective. Ultimately, what you need is you need a rug pull kind of situation. You do have a potential for that this week, because my sense, even though Google and Microsoft and Meta are all down, people will be buying Amazon and Apple calls. So if we have the situation where people are long these into tomorrow, it's for Friday expiry, kind of a lot of call buying on the tape. If those numbers don't come in and those stocks are down, followed by the ECI and the PCE on Friday morning being hot, that's how you get the market off sides on a day. And so all the call buying gets eviscerated. There isn't as many puts out there anymore like there was, say, 10 days ago. So then people can kind of come in with that 0 days to expiry put buying on Friday and try to press this, materially lower on this idea that, okay, the earnings didn't come through, and this idea of a Fed pause, it's too soon because the data, we just printed another record PCE print. I'm not saying that's going to happen, but if that's how it plays out. And then we walk into an article over the weekend from, the Wall Street Journal that says, something that's opposite what he said last time, because he's going to write another article and we're going to have to assume that there's a reason why he's going to write another article. So I'm thinking that's kind of how, things are going to play out over the course of the next 7 to 10 days. The payroll print on next Friday will be strong. I saw UBS today is looking for 350,000 payroll, in payrolls. Streets at 200,000. So we're going to start to walk those numbers up. There's no signs of a labor market that's deteriorating. That's your risk off trade. Now, I think if that led to, let's say, a sizable Republican sweep.
Oh yes, this is
on the election. I think that's probably something that maybe that helps put a bottom in the tape. Hard to play politics, but people will believe that Republicans in there mean, inflation is going to go away because there's going to be no spending, and a lame duck then becomes good for equities. Ultimately, I do think that's, while that may kick off a year-end rally or Santa Claus rally, that is setting the stage for an awful 2023. Because then we will be in a situation where we will get no fiscal aid, we will get no fiscal help, we will have earnings deceleration, and we will have a Fed that is not any closer to adding liquidity. So I think that sets us up for a Santa Claus rally fade, and then we're looking at much lower equity prices in first quarter of 2023. So that's kind of phase 3 of this. So it's down first, counter trend move on some hope and some maybe Republican sweep. That maybe that's I don't think I'm going to necessarily play that through equities. That counter trend move. I think it's better to maybe play that with oil or gold or Bitcoin or something that's kind of this liquidity, benefits from this inflation, benefits from the thought of liquidity, and then look to kind of maybe get shorter equities as we kind of transition into 2023, because I think we're going to have a pretty crappy fourth quarter from an earnings outlook perspective, and those first quarter prints are not going to be good. So that would be kind of my base case of how I think this kind of plays out.
okay. Had a question on gold, especially with Brainerd really talking about a real rates rally that's typically negative gold. I still don't see anything yet really strong, and I don't mean this short-term bounce in bonds, yen, and gold that we've had since the BOJ intervention, which we literally caught live in the trading room, and I mean it's really played out as a trade. But gold as a hedge or as an asset that's going to outperform hasn't really triggered yet for me. Do you have any comments as it relates to holding gold in a rising real rate environment?
Yeah, what I'd say is real rates have been rising now for well over a year, and gold's actually held them pretty good. If you kind of pull up gold versus these real rate charts, it's actually way outperformed expectations versus where you would have expected it to be given where real rates are. So what I think is ultimately gold will anticipate the necessary liquidity that the Fed will bring. And so at some point, and the fact that it hasn't been rallying yet in a material way suggests to me that there is no anticipation or there's no reality behind a Fed that is going to release liquidity back into the market. At the point in time when risk assets are low enough and people are fearful enough, gold will say, okay, the Fed will now need to pause or pivot or cut or whatever, and then gold will start or stop QT. And then gold will start to, really outperform. So the reason I like buying calls here is like, look, it's very possible that the Fed will fold and they will just say, you know what, we tried, but we are, we're not going to be as aggressive anymore. Growth is slowing, whatever. They'll make up some excuse. So, having gold calls kind of allows me to, be there on that day that they come out and say that. I mean, gold has held in okay here, post the Timoros article. It's not okay. I mean, obviously it's lagged, but it has bounced off the lows. Bitcoin has bounced off the lows as well. I think that's another, place where you can get some data on this idea that the Fed will add liquidity again. But yeah, look, I think that the fact that the charts don't look good, from your perspective, suggests probably that we're not going to get the dollar liquidity that maybe is being priced into equities right now, and that's being priced into the market narrative.
Yeah, I definitely have keen interest on following this chart that I mentioned. It's really just a stock bond ratio, and the right side shows that monthly, what we have obviously broken down, which is basically risk parity, right? Stocks and bonds have sold off together. It's dramatic. Bonds are down, aggregate, global bonds down 20%, and stocks down even more. But the point is that to me is busted. So if the Fed does not continue to raise rates, in other words, this continuation of bonds selling off and yields moving higher to fight inflation, then I believe oil will absolutely spike back up. This is really the season for midterm elections has created this suppression of oil. I was asked about that in chat in regards to what happened to oil. So it hit that 130 in March. That happened to be a price target from a year earlier, and then it came back down and it broke 93. So 93 for me in West Texas Intermediary crude is absolutely the level it needs to get back above for this next spike higher. So if yields do start to come down and stay down, there's no question in my mind that oil is going to get up and stay up. So they really have only one choice: raise and keep raising to keep oil down. If they do not, oil will pop up like a daisy and keep going. I've been very focused on that, but nothing has changed. None of my analysis has changed.
What the Fed is, the administration has, done, what clearly it's political, but look, they've tried to save our allies as well, right? In order to prevent Japan and the UK and Europe from selling even more treasuries to raise dollars to buy oil, what the administration has done is help keep the oil price down by depleting the strategic petroleum reserve.
Yeah, so absolutely.
So, they have kept the oil price down to basically prevent our yields from blowing out even more.
Correct.
The issue now is that we've basically depleted the strategic petroleum reserve. We are at lows of from 30-year lows or whatever, 40-year lows, and there's talk of diesel shortages in the US.
Yep.
So my sense is after the election, it's going to be very difficult for this, just mathematically, the pace can't continue like this, but even optically, after the election's over, they'll probably, start talking about stopping this plan to end the year, and that is also likely to bounce the oil price further. So look, and Saudi and Russia are shrewd global actors, 4D chess players. My sense is they are not so keen on seeing the oil price materially fall, from here. And so if we get that situation where the SPR releases are finished, Russia and Saudi want to see a higher oil price. It's winter. That's clearly the winter trade actually is helped Europe, so far because it's been warm, so they haven't had their gas issue. If that comes back, we're off to the races there on gas. But if oil prices are moving higher, then I think that the headline inflation story comes back. The Fed and other central bankers will have lost if they wanted to pause their rate hikes, and then yields will have to move materially higher to slow demand, and we'll be back, back again doing the same dance. So that's why I like, I own oil calls as well. Just similar reason. If we get the Fed pause, if we get a dollar weakness, it's good for oil. If this SPR stops releasing, it's good for oil.
And this isn't even a supply demand debate, right? We're really just talking about this being if the dollar yen moves higher, then it helps to keep this suppression of oil. If it pulls back and the dollar with it, then oil pops up. Gold also pops up. So the oil and gold trade, big picture, are definitely related to yields and FX. So I'm in the same camp. There's also, of course, supporting evidence on a macro, energy crisis theme, or on a fundamental supply depletion theme post, election. But we have to get through the election to really see, I think, some movement in yields and oil and gold. For me, it's a package, and dollar. So those four are the most important. Macro makes absolutely everything else in equities run. And that basically is then these little, live trading room moves. Oh, let's go chase this and short that because we can see it on a shorter time frame. But big picture, the macro hasn't changed. There's still a lot of risk. It's growing, and a major policy error, we'll find out, right?
Yeah.
If they speak the words pause and we see oil shoot up like a rocket, then it's really the tell. But yeah, I'm very glad that we could do this again because we definitely had some very strong bearish intent in our last webinar. Wanted to update that because the macro landscape changed based on government intervention, but we still have the same risk factors. What's kind of streaming on the shared screen right now is this MacroADVISOR bundle that I had talked about at the beginning. And in a nutshell, this is the whole purpose of kind of adding a flavor of why things are moving and how to anticipate it, because macro is making these market moves, not it's just not by itself a technical market that is standalone. And I really want to encourage those who might be interested, not just in the Fishing Club, which has more of that tactical trading, but also Craig is very tactical. I mean, you are doing trade engagement and support with edge clients, and then you're posting your macro analysis for clients in our client workspace for Slack. So we're offering a special for those who want to sign up and work with us both. We also, as part of the Fishing Club, I have 6 other contributors. So we cover futures and, it's across all time frames and all asset classes, but definitely wanted to thank you very much for attending today and check out this special, which is for your first month. And we are very much looking forward to figuring out if we're going to have some follow through to the Fed on clearly next week. But I would say the risk is not alleviated. We just have a stay of execution as far as we don't have a full pardon yet. I don't suspect that that's really in the cards for this year. But if we do, then yes, it sets us up for more kind of weakness in the new year. So thank you for sharing those macro observations. Any other final thoughts?
No, look, I mean, I think, what I try to do is have a framework for where I think asset prices are going. And then I try to use, gross exposure to manage when things get oversold or overbought. And, look, I think that, I certainly could trade these counter trend moves better. I'm still learning. I've been doing this for 20 plus years, and, you still learn and still get, the market still is humbling constantly. But, the data really needs to change in order for me to really feel like, I need to change my positioning or change my outlook. And I'm just not seeing it. And so if I'm losing money, I'm grossed down. I'm waiting. I'm trying to identify the points in time where the narrative can shift back the other way. Often that happens into central bank meetings or, data releases. Well, we have a lot of those coming up in the next, few days. So, and look, and I will have to have some hedges against that negative view. And I think having the, inflation hedges like a long gold or a long Bitcoin or oil against a kind of, generally underweight equity view, I think is a good balance to have kind of into these events that are happening over the course of the next, few days. And if I get more signs that, I'm right and that the narrative hasn't changed, and I can get more aggressive and raising, short exposure on the equities. I suspect that's how this will play out.
Excellent. Well, thank you so much, everyone, for joining. I wish you a great end of the week. Craig and I can be found on Twitter, also through Fishing Club, MacroADVISOR, and our Institutional Edge product. Let us know if you have any questions, and enjoy Apple earnings tomorrow evening, because I think we're going to have a very eventful Friday morning.
Yep.
All right. Cheers, everyone.
Take care.
Bye.
Bye.